what can they do to build some of those relationships and start to get into those networks? Because that could be a challenge.
Hmm.
Just getting face time.
You make a very relevant, very interesting point, because this second company I'm talking about where I went to this guy who's one of the top angels in the UK and got all these introductions to various people and this independent funding. The two founders had done nothing in terms of building a network into the investor community. And when I'm saying, look, I'm engaged to help position you and prepare you for investment. Investors don't want to see me.
Yeah.
They definitely don't want to see me. They want to see you. You're the founders. Yeah, but we don't know anybody. So what do we do? Well, in the event, I was able to help them. In answer to your question, most founders, early stage CEOs, they do not understand the investor. They do not understand what the investor wants, what the investor is looking for, what the investor expects, because most of them do not step out of their own entrepreneurial world. Then, in some cases, understandably, I've had startups where I've been so totally immersed in this, and if you came along as my advisor or counselor, you said, Bill, you have to get out and talk to investors. I haven't got time. I don't have time. I can't do that. You can do it for me, kind of thing. And you'll be telling me, no, they don't want to listen. They don't want to see me. They want to see you. So I would, when you're at the point where you are going to need to raise a small but significant sum for your startup, and let's say I might just need $250,000, and it's a horrible number because nobody's interested in $250,000. It's more effort to invest $250,000 than it is 2 million or 5 million, as entrepreneurs will find. But you come along and say, well, I need this initial kind of little kickstart. I need some fuel in the tank. We might have a conversation where I'm saying, no, you don't do that. Let's look at it again. Let's have a look at the longer term projections. Let's look at the cash flows. And you go, no, you could actually use $1 million. But when we go out for $1 million, we're going to agree to take it in tranches.
Yeah.
And that shows realism on the part of the entrepreneur, the founder. It de-risks the 1 million investment for the investor or investors. But you're counseling me about my raise, and you'll be telling me, look down the pipe. You're going to need this money. We're now in September 24. You're going to need this money. Well, you tell me you want it next month. Well, the realistic timescale is you'll probably get it by next June, which, by the way, is another failing of founders. They think that, I need money. I'll probably need it in 3 months. I'll go out and raise it. Yeah. Well, 9 months is a typical time period for a raise. And it's surprising how that time is consumed, because if you work backwards, there are a number of cases where between the agreement, an exchange of emails which go, yeah, we like the idea and we like the general terms, let's proceed, to cash in the bank can be 4 months. Because first of all, we'll sit down and we'll prepare a term sheet, or the lawyers will prepare a term sheet, or somebody will prepare a term sheet. And then that goes backwards and forwards, and it gets edited and altered and changed. And then the term sheet comes out and everybody comes around and signs it, and that's okay. So now you've probably got a month past. Now we get to the shareholder subscription agreement. Well, that now is, we're now nailing down more and more detail of terms and conditions. And that could be another 1 to 2 months. You might have 6 investors. The 6 investors are not sitting around waiting for you. You know, 2 of them have gone skiing, and they'll be back in February.
Yeah.
And then when they come back in February, the first one's also gone skiing, and he's going to be back in, you know, in the beginning of March. So people don't sit around waiting for you to come along and say, will you please read this and sign it?
Yeah.
They'll come along, they'll acknowledge receipt, and they'll, well, I'll read it next week.
Yeah.
There isn't the same degree of urgency who they're pushing investors, with one exception. And that is where you've got angel investors or friends, family, and acquaintances who are investing, who can take advantage of SEIS or EIS in the UK. And they're coming up to April the 5th, and they want to get their SEIS. You know, they've invested 50,000 in somebody's venture. They've got another 200,000 they can use this year. They've got a degree of urgency.
Yeah.
But that's driven by the tax situation.
Sorry to interrupt. Going back a second, you said a minute ago that founders, entrepreneurs often don't understand the perspectives of investors, angels, that sort of thing. Can you elaborate a little bit further?
Yeah, I think you have to get into the mind of the investor. So